Hello, welcome to the reflection for task A of the SAICA APC December 2022 assessment. So this is the reflection deck. And what we do in the reflection is just to go through the PRI. So we actually ignore any information that we might be aware of when it comes to the IOD. And we just deal with the PRI in the way that we believe that it will have been insightful. It will have demonstrated the pervasive skills that are expected from you. And it will therefore put you at a very good position to do well when the IOD is then revealed on the day of the assessment. So let's then look at this. So this one, you will remember that it was, or this particular task we are looking at, it arose from email number 2 from the PRI. And it was from Elijah, who we now know is the CFO of FJ. So the email then reads as follows: subject, Big Ranch Pty Ltd. Then, based on the information that we've already covered, we are now aware who is Big Ranch. We are also aware in what context they were introduced to us. Because as I said in our Setting the Scene session, it is very, very important to be always in context. Do not allow yourself to be removed from context when it comes to unpacking the PRI. So now we are told that this is the matter that Elijah is interested in focusing on. Then what did Elijah have to say to us? Hi, again. Hope you are settling in well. Just a heads up. You may have noticed on slide number 19 of the PowerPoint presentation I emailed to you. Which one is slide number 19? We wonder to ourselves. And I'm sure at this point you started paging back to say, which one? That FJ has not yet prepared any pro forma journal entry regarding our acquisition of 100% of the equity interest of Big Ranch. So this was very interesting to me. So they are saying that we have not processed any pro forma journal entry regarding not our investment in Big Ranch, but rather regarding the acquisition of 100% equity interest in Big Ranch. So you might be saying that, but Rendani, did you not just say the same thing? Yes, you use different words, and therefore one is just maybe trying to be fancy around it. But what is then the subtle difference between the two? Or at least for me, when I read it, there was that subtle difference that had an impact. Because if you then rewind, you will remember that they told us the year end of FJ is in October, but the acquisition happened in July, meaning that there will be what we call a post-acquisition period from July up to the 31 October year end. So now, if that is then the case, I'm now sitting here and I am wondering to say that what is the trigger asking me to think of? Is the trigger asking me to think of only the entries that relate to the acquisition, which we normally refer to as the at-acquisition journal entry? Or is it asking us about what? Is it asking us about the at-acquisition journal entry and the post-combination accounting from July to October? I'm relieved by the fact that we've got 100% equity interest, though, because it means that I don't need to be doing an analysis of equity in my mind so that I can see the numbers going to the NCI. So that is not going to be necessary because I own 100% of this company. Then they say, for the purpose of preparing the group's 2022 consolidated AFS. So this was now throwing me both ways to say that, but wait, I thought it was a matter of I'm interested in the acquisition. But I know that the acquisition entry cannot just go into the 2022 financials and that's it. There must be some subsequent post-acquisition accounting that needs to be done. Then they say, I will need your help with this. I will send you more information next week. Imagine. So this trigger is very light and it's very dangerous. How so though? Because it's triggering a very complex standard, which is IFRS 3. That's number one. And it is saying, you know this standard. So I don't need to give you so much detail about what you need to do. But wait. How will we have known so much about IFRS 3? Because it is fully examinable in CT as well as ITC. Fully, I'm just saying that in a comprehensive manner rather than, maybe let me say comprehensive manner rather than fully, because there are some sections that are excluded. So now I'm sitting here and I'm saying that it means that if I was weak in IFRS 3, I need to start putting in the hours. But if I've just written ITC, if this is what I do on a daily basis, then I understand also the trigger. But for some of you, you might find that this trigger might have been, what is Psycha expecting from me? So if you are in that boat, you will then see how we then unpacked it in the next couple of slides in order to just help you with understanding what is it that is of core in this particular question. Because Elijah then concluded the email by saying, I will send you more information next week. To do what? To do the journals? To review your journals? To what could it be? We wonder. But just to remind ourselves about that slide 19 that Elijah was referring to. So I've highlighted the part that is much more important for us. FJ acquired 100% of the equity of Big Ranch with effect from 1 July 2022. FJ has not yet processed any pro forma journal entries with regards to Big Ranch. Do you see the difference between this right here and the email? The email said with regard to the acquisition of 100%. But now this one says with regard to Big Ranch. So there was inconsistency with the trigger. And if there was this inconsistent, and I'm the student sitting for this assessment, I will go with the trigger that will make me do more work. Because if I had just gone with at acquisition, then I've limited myself and I could find that they will need much more than at acquisition. But if then I find that there's less, whereas I've prepared for more, there is no harm. I can still go with a C. So as a risk-conscious person, the latter of doing the more and then getting the little, it's much safer for me, and I'll approach it that way. The cash amount paid for the acquisition is reflected as an investment in FJ's draft financial statements. So this amount is not to be paid. This amount has been paid. So now what am I getting on this trigger? So this is our way of analyzing the trigger. This is EPC's way of how we package the work that we are going to do. So in this, we always have then 4 columns. The first one is the trigger that we are taking. And a trigger, remember, it has to trigger something that we need to do. But the question is, what do we expect to do? Because you want to avoid yourself from just seeing everything as a trigger. So here, we will remember that a trigger is triggering an action. A trigger is triggering an action. But we will need to establish what is that action. What is that action? And maybe just to go back to the definitions. If you Google what a trigger is, it says it is an event or a situation or something else that causes something to start. And in our context, it is that triggers us to do something, to start with our research, to start with the work expected from us, to start with the thinking, like we are meant to be triggered to do something. So now the question is, what is that something that we need to do? And that is column number 3. Column number 3 then tells us that we need to either obtain an understanding or update our understanding. In relation to what? In relation to the triggered task, or rather the anticipated task. Why will Elijah just out of his mind or her mind just type an email and it does not expect us to do something? So we are expected to do something, but our expectation to do something, it is linked to what we expect to do. So now I'm sitting here and I'm saying that if you have not yet done the journal entries, I'm expecting that you will ask me to do it. That's it. I'm expecting that you will then say, prepare these slides, account for this, review this. That is what I'm thinking I'll be expected to do. So in my mind, I'm saying that I will then be thinking that I'm expected to prepare the at acquisition journal entry. But from what I've just said now, I'm going to go a little bit wider and say, I'm going to prepare the pro forma journal entries, including the at acquisition journal entry. Or otherwise, I might be expected to review the pro forma journals done to account for the acquisition of what? Of Big Ranch. So that is me. This is what I'm expecting to do, given the trigger. So Renat, how did this get informed by the trigger? Because they said that FJ has not yet processed any pro forma. So maybe next week Elijah will say, I thought things would have been different. I thought I'll get the time to do it, but I didn't. Please assist. Or otherwise, Elijah will come and say, I had thought I'll then have time to finalize this. Oh, I had wanted to finalize this, but as I was working through it, I got stuck because I've not done EP3 in a while. So please help with reviewing the work I've done. So what is it then, given that these are the anticipated tasks, what is it that we are expecting to do? We are expected to update our understanding. Why am I updating my understanding and not obtaining an understanding? Because this thing has been done in CTA. This thing has been done in ITC. So I need to revise the business combination accounting with the emphasis on the acquisition journal entry, because that informs my post-acquisition journals. Then I'm going to consider the related standards applicable to acquisitions, such as IFRS 13, as the identifiable net assets and consideration transferred need to be measured at the acquisition date fair value. So I'm clear that I need to revise, which is the actual work, and I need to consider the other standards just in case the future. So now I then need to revise. I'm saying I'm now revising my understanding of IFRS 3. So this is just a snapshot. I've already shared the videos for CTA with you, and I want you to do the detailed work on it. So here what I'm illustrating is that when you talk about business combination accounting, we are focused on 4 elements. 1, the consideration that has been transferred. 2, the measurement principle. 3, the recognition principle. So those are the 4 primary things. Then from them flows things like the measurement of non-controlling interest, as well as the measurement of any previously held interest that we might have had. So that is our starting point. So if I say I am good with business combination accounting, I'm talking about this. Okay? So I will want you to then have a look. And I know that some of these concepts might have been a little bit foreign. I mean, you might be saying that I've looked at this before, I've seen this before, but I've not done it in a long time. And for me, that's where the CTA videos come in. But they're not coming in as I saw business combination, I need to study everything. No, they are coming from our structured thinking. We have now just identified what we need to do given the anticipated task arising from the trigger. So now do you see that I am trying to solve for what I've put here? If anyone in your group sends you content that does not solve what you guys have agreed to in this column, hold them to account. They need to account, why did we agree that these are the anticipated tasks and that these are the actions that we need to be taking, and you go and do something else that does not contribute to that. So that is how you measure the effectiveness of the group, not by who talks a lot, not by who's got more confidence, not by how many seats that they got in their program. No, it's all about sticking to the plan that you will have agreed. If a deviation is necessary, debate and discuss and agree. But now everything that I need to do fits in here. So I have in hindsight now, not that I will have excluded it, but now in hindsight, I know now that they didn't go into the detail in a frustrating. So I'm not going to be wasting your time. But if they had done so, I will have then unpacked this consideration that I've already raised down here. So now let's go through a high-level summary of this. Remember that you've got the detailed lecture videos on this. Okay. So let's quickly discuss this at a high level. So this calculation or the illustration here says that we've got goodwill on one side. Excuse me. How do we determine goodwill? We say that goodwill is calculated as the consideration transferred plus the previously held interest plus non-controlling interest minus acquisition date fair value of the net identifiable assets. So as I'm saying, if you are seeing something and you don't know what it is, you've got the videos to work through the detail, and I'll encourage you to do so most diligently. So when we talk about the consideration transferred, we are interested in 2 things. Firstly, the nature. Excuse me. Firstly, the nature, and then the measurement of that consideration, as well as whether it is part of a business combination or not. So it's not 2, actually it's 3. So what is the nature of the consideration? How do we measure it? And whether it is indeed part of the business combination or not. So when we talk about the nature, we are recognizing that consideration is much more than just cash. Consideration can be non-cash assets. It could be a contingent consideration. It could be a deferred consideration, a liability that we assume, equity that we issue, or we could obtain control without any consideration at all. So this is the nature. So that means the first thing that we will need to ask ourselves is, in this acquisition of big ranch, what consideration or what is the nature of the consideration transferred? Then next, it's to talk about how do we measure it. Then the standard is quite clear. It says the consideration transferred has to be measured at fair value. But it then makes a single exception for the assets that are transferred not to the former owners, but rather to the acquiree, being the subsidiary company that we just acquired. And it also, under consideration, talks about that there are transactions that are entered into near or as part of the business combination that sometimes can be confused with business combination transactions. And the standard says that, therefore, it's important that when we talk about consideration transferred, we only consider what is part of the items that have been exchanged in a business combination. Simply said, it should be that you are giving me a business and I'm giving you the consideration. But if now this transaction is doing much more than that, then it is no longer, excuse me, then it is no longer part of the business combination. Then what could that be? It could be where the parties are settling a pre-existing relationship. Or rather, it could be a situation where they are reimbursing each other of the transaction cost incurred on behalf of the other party. Usually, the former owners being reimbursed by the acquirer. Or it could be a situation where now you've made a payment for future services. Because the trigger was quite broad, we needed to come in understanding quite a lot of this. But you will then see that based on the context already, there were some things that we could have started thinking about and identifying. Then we've got previously held interest. And in this particular instance, there was no evidence that, excuse me, FJ had any what? FJ had any interest prior to acquiring this. How so? Because they said we acquired 100%. You can't acquire 100% if you previously had something. So we know that we are acquiring 100%. Then the non-controlling interest, what is it? It is the interest that we don't control. But since we are acquiring 100, this is also not applicable. So we don't need to worry about it. There is no trick in this instance. Then what do we deduct from the sum of the above? We deduct the fair value or acquisition date fair value of the net identifiable asset. So two principles are important here. One, whether something is indeed an asset or not, where then we talk about the recognition principles. And if it is an asset or not, then we talk about how to measure it. So let's start with the recognition principles and or condition. So here, two things are important. It is the general principle and where there are special cases or exceptions. The standard is quite clear that the things that we need to capitalize are the items that meet the definitions in the framework at the acquisition date. In other words, the asset needs to exist and the liability needs to exist. What is an asset? Refer to the framework's definition. What is a liability? Refer to the definition in the standard. But then we are told that there are some exceptions, like contingent liability, where we are told that we have to measure, so we have to recognize a contingent liability when certain conditions are met. Which conditions are these? And additionally, it talks about what? Reinvestment asset, where it talks about the fact that we will need to do what? We will need to recognize a reinvestment asset or otherwise an indemnification asset to the extent that it relates to the contingent liability. And there could be also lease agreements that existed that we are now taking over. The standard has specific rules about those lease agreements. Okay, then now we have recognized those. Recognize, bring into the books. Now, how do we measure them? When we bring them into the books, this is the rent amount guidance. So it is saying that the general principle is that, sorry. So it is saying that the general principle is such that at acquisition date, all the assets and the liabilities, they are measured at the acquisition date fair value. All of them. We need to therefore be clear what is the what? The definition of fair value. And the key thing about it is that it is the value from market participants. When now the standard goes into detail about some assets that the acquirer might intend to use differently, then we've got this concept of the measurement period, where now if you don't or have not finalized the acquisition within by the reporting date, you can provisionally estimate an amount, and later on you could then do what? Later on you could then be given an opportunity to rectify that. Then against this principle of measuring everything at fair value, there are two things that we need to be mindful of. There are a few things that we need to be mindful of that are measured outside this principle. Those are assets held for sale, as well as deferred tax assets and acquired lease agreements. So this is a snapshot. I will want you to go through the detail in the videos and make keynotes ahead of your session on IOD analysis with asset. So now I'm going to pack it here. Specific consideration to FJ context. So when it comes to the consideration, when we read, we noticed that they said that what has been shown is the cash amount paid for the acquisition. So I've got a question that, did the consideration only include cash, given that the consideration can include other items? That's number one, the nature. Number two is, when was that cash paid? Was it the same date as the acquisition date? Because if it's no, there might be a need to consider the time value of money effects. Then also, we need to consider whether everything that has been included in that cash of 14.5 million, it's indeed part of the acquisition, and that there is no settlement of a pre-existing relationship between FJ and Big Raj. Why will it exist though? It will exist because FJ has given the franchisor rights to Big Raj to operate the franchises. And now that we are taking back control 100% of Big Raj, we are also taking control of the rights that we had given them. So there is a reacquired right. And a reacquired right has to result in settlement of a pre-existing relationship should the terms of the agreement be different to market-related terms. That will potentially give rise to either a gain or a loss, which is the pre-existing relationship that needs to be settled. And accordingly, you will then have an adjustment to consideration. So it seems that the examiners at this point, they had given us enough to do everything. There is no specific limitation which will then constrain our thinking to say, no, here the focus is the nature and the measurement. But everything seems to be fair play because given the context, these could all be assessed on the day of the assessment. One of the other things that has not been mentioned is transaction cost. We don't know whether that 14.5 included transaction cost or not. So that could be another separate transaction on the day. That instead of treating this transaction cost separately, they might have capitalized it. Then the recognition principles. Then we know here it's about what do we have to recognize, which one are the assets and liabilities. Then we are saying that the Big Ranch might be a brand out there. So one will then wonder whether that will meet the separability criteria, the Big Ranch brand. Because remember this Big Ranch, which holds the Fooders, the Fooders franchise agreements. So there are 5 Fooders restaurants under the Big Ranch brand. But some might know that, yes, Big Ranch is actually good in 1, 2, 3, such that when you take over it, people will be willing to pay a market-related fee for it, and therefore giving rise to the brand asset. Then there could also be reacquired rights that I've already mentioned, since FJ is buying back what? It's buying back its franchise rights from Big Ranch. And because we are told that Big Ranch is not doing so well, there could be costs to restructure Big Ranch. What does the standard say about it? Do they meet the definition of a liability at the acquisition date? But do you see, when I'm in context, I am asking the relevant information from the given information that I've got. So that is the application of critical thinking. I'm not just going in with just principles on IFRS 3, but I know and I'm clear about some of the things that I'm thinking about. Then measurement principles. Given that this is a forced sale, Big Ranch is not doing so well. I'm now thinking that, wait, in IFRS 13, they talk about a transaction happening in an orderly manner. But this is not happening in an orderly manner, perhaps. Because of what? Because if I'm struggling, I'm willing to accept a lower price to exit or to get the help I need. So one might need to be mindful of whether the acquisition is taking place in an orderly transaction and whether the prices that will be signed on will reflect fair value. Do you see that? All in context. These are not things that I'm just coming up with. They're all in context. Then the next one, it is the brand. How does this big ranch brand fit in? I've got FJ as my primary brand, and the restaurants operate under Fooders. So why will I need Big Ranch? So it could be that this brand has no value to FJ, and they might want you to think about how to go about measuring it, given the intention of the management of FJ versus market participants' view on the brand. Then we are told that these franchisees enter into lease agreements. We know they don't enter into lease agreements in high population malls because those rentals are expensive. But we know that they've got physical stores that will require some lease agreements. So when we enter into this, we could find that some of those agreements are coming to an end, and therefore they meet the definition of a short-term lease, and they might need to be derecognized as right-of-use assets. Or otherwise, we'll find that they still have some time, but the way we measure them in accordance with the guidance in IFRS 3, as if the lease agreement was entered into on the acquisition date. So we need more information about the right-of-use assets and the lease liabilities. But we are recognizing that these things are not easy stuff. They require focus from us. We need to be present enough to get all this kind of detail. So this is something that we always say and encourage candidates to do, that don't just go and know your content, but know it in the context of the case study. These are all things that are putting me at an advantage, because if they are unpacked on the day, these are some of the things that if I've not thought about initially will likely throw me off. So I will need to always have things that I'm thinking about. How will they be resolved in the what? In the case study itself. There are some candidates that introduced me to this term to say, my what if scenarios. And I liked it. And that's exactly this. I might be calling it to say in the context, but you might say, these are my what if scenario. But notice that the what if scenarios are not just some weird and unstructured what ifs. They are all related to the context. They are all related to the context. So please consider this and apply appropriately. But remember, I'm just one member of your team. So in your team, you might say, we have seen what Rendane has put on the table. What is our own view? So I'm keen to also hear your view. And I'm sure when you engage with us, and you'll then unpack this even more. Then lastly, goodwill. I will expect that they might have a gain on bargain purchase. Why? Because this big ranch is not doing so well. And there's no need to worry about NCIs we've spoken about, because we are acquiring 100%. And furthermore, it's worth adding that there's no need to worry about previously held interest, because we've just acquired 100%. So that is what I wanted to discuss with you as part of the reflection. So I hope that it allows you to reflect on your own thinking, on your own structure, and by the time you discuss this with us, you're on top of your game. All the very best, and enjoy the session. Cheers.